right, well, let's roll with it. If we need to adjust it again, just let me know. So, harmonic patterns. There's been a bunch of hourlies and even some longer-term 4 hours and a few dailies showing up recently. You can see here on the Trade Finder. I'll go through the actual charts in a minute, but I just wanted to show it there. I'm going to go through the projections. I've already done this morning with my FOREX Profit Predictor group. And so I'm not going to go through everything. I can tell you, obviously, as I kind of heard Ed reflecting at the end of his presentation this morning, saying the market is in the doldrums, basically. We're in a period of time where it's, long periods of dead sideways activity followed by short bursts. It's not uncommon at all for it to be like this during the depths of the summer, because frankly, half the world's on vacation, basically, and rightfully so. And the other half wishes they were. I said that this morning. So the environment that we're working with really, I don't think, should be a surprise to anybody. At least not anybody that's been in this business for any longer period of time. So that said, there's still a few things that are somewhat interesting. The Swissy had some short-term, this was earlier this morning, some short-term downward projections, 15 and 30 minute that were looking pretty good, and we've already seen them start to play out. Little longer term, short term, the Euro Pound 5 minute, 15 and 30 are all starting to look for some kind of a dead cat bounce to ensue. I heard Ed saying selling the crosses on rallies, this one in particular, and so I don't disagree with that at all. I think here you can see that there will be likely some kind of a short-term rally over the course of the next few hours or maybe day or so at best, and may be able to take advantage of that from some of that strength on the short side later on. The euro itself doesn't seem to have too much in the short term that's exciting. We did see a little jump this morning off of those 830 numbers that we had, but honestly, that market has been held down. The euro, I hate to go fundamental or anything on anybody or non-pure technical as I usually am, but if you look at the commitment of traders and or look at sites like Currency or Zulu Trade or any of the big social aggregate sites of what traders are doing, you can clearly see on them what the overall traders are doing. Oanda provides this data too on one of their websites. There's a bunch of places you can get it. It's not like it's secret. It's no big deal. In fact, FX Street may have it. I'm just not 100% sure. But you can see where the majority of the so-called trade is. And overwhelmingly right now, the public is short the euro. The overall trade, not just the public, but even the institutions and whatnot. So if everybody is on the same side of a coin, what do you think is likely to happen? Where do you think the spikes are most likely going to be? They're going to be in the other direction because you're going to catch more stops. The market's going to capture more orders. And it's not malicious. It's just that's what it does. The market needs to feed on orders. That's its lifeblood. So if there's more orders on stop because there's so many people short, there's more stops above the market, then the up moves are going to be more violent than the downside follow-through moves, right? It's just common sense. So that's exactly the environment we're working in. I would say right now you have, when the trade gets this one-sided, you have pretty big potential for what sometimes is called a short squeeze. Dead cat bounce goes by many terms, but bottom line is a sharp move against the overwhelming herd. So I'm not calling for that. I'm simply warning that that's typically what happens when the trade gets this one-sided. And longer term here on the 180 projection, this is the Euro 60-minute, 120, and 180, so 1 hour, 2 hour, and 3 hour charts. You can see the 1 hour is not looking for much energy other than what we've already seen. The 2 hour is actually still looking to cycle lower, but the 3 hour has that, like I said, that potential for the big short squeeze still left in it. Let me pull up some regular charts now. All right. And I'll start with the Swissy again. Here's the Swissy, and this is the bearish 4-hour harmonic butterfly pattern that I mentioned a little earlier. You can see the B point's basically down here at about 96.50, 96.75. We were trading a little earlier this morning at about 98.50. Now we're at 98.30. We've seen a bit of a move towards in the direction of the B point, but not any kind of major follow-through. The bad news is the PRZ is pretty huge. It still extends all the way up another almost 200 points. So the only way to trade this, of course, is to break it up and run the stop above the recent highs, basically somewhere close to that 99 handle, or above, like I said, somewhere at least above the old highs. And that still ends up giving you a pretty decent risk-reward ratio, depending on exactly where what your parameters are, somewhere between 2 and maybe even as good as 3 to 1. So it's definitely a worthy contender, but again, in this environment that we're in the doldrums, just to expect, this is a 4-hour chart, okay? This took since June 1st to build. It's now July 15th. That's 6 weeks. So if we divide that by 3, it's at least going to take 2 weeks to play out. Possibly a full 6 weeks to play out, given that it's the doldrums. So to have the expectation that it's going to move back to this B point tomorrow or next week would be delusional, I think, at best, and foolish at worst. So it's likely, in other words, I guess I'm trying to say is it's likely it will happen, but I wouldn't look for it to happen anytime in the immediate present. And the journey to get there could yet be very sloppy and choppy along the way. One of the things that, in fact, let me switch back over to the other charts because it'll show this even a little bit more readily. Hang on. These are the cycles of the British pound, the cable, British pound, US dollar. 60-minute, 120, and 180 again. And here you can see we have total lack of agreement between all three charts. The 60 minutes pointing down at a lower cycle. The 120 is showing strengthening cycle, and the 180 is showing sideways choppy cycle. It doesn't get any more mixed than that. The market can only do one of three things, and this is basically saying it's going to do all three things. So for some people that may seem like it's not giving you a good signal, but in fact it's giving you probably one of the best signals you'll ever get, which is, okay, I used this example this morning, so those of you that were there this morning, bear with me, but I think it's a good example. I'm a surfer. I live at the ocean, the beach here in Florida, and, you know, if it's stormy, if there's a storm out there brewing, or if there's even just, you know, a small storm out there, you get all kinds of crazy cross currents, right? There'll be waves. Don't get me wrong. There'll be plenty of waves. But will those waves be rideable? Will they be worth paddling into? Oftentimes the answer is no, right? I mean, anybody who knows surfing knows that. Just because there's waves doesn't mean they're worth paddling into. And it's the same thing with the markets. Just because the market's moving doesn't mean there's something to get into. Whether or not you paddle out is not dictated by pure movement alone. If it was, you would be a jackass, to put it nicely, right? You would be a moron. You would be a dead surfer. And it's no different with trading. Just because the silly thing's moving, just because there's waves out there, doesn't mean there's waves that are rideable. There doesn't mean there's anything out there that's offering you a strong probabilistic edge, or from surfer speak, a sweet ride. You know? I mean, it's really the exact same thing. So when you have this Forex profit predictor and you're looking at these cycles, for me, it's incredibly informative, just like it's incredibly informative to walk out to the beach and look and see, hey, there's waves, but there's massive cross currents and the waves are all choppy. And even if I could paddle out, what the heck am I going to stand up on? What's worth getting up, getting up on? Probably not much. Probably just going to get beaten around, get exhausted swimming, and come back with little more than a good workout, maybe. You know what I mean? But, and at worst, the worst case scenario is you actually drown and die because you're foolish enough to go out in a less than optimal situation. And there's no heroes in surfing or in trading. So, anyway, my point is, I think that's a long-winded way of saying that flat is a position. And when you have tools that tell you that the currents are choppy, it behooves you to listen. So hence, I'm pretty flat right now. I don't have a lot of trades on, if any. Actually, I'm only in a couple of small ones, and that's not even anything that I'm too excited about. Yep, old bull traders and bold traders, but no old bull traders. So anyway, that all being said, it's a great time to be doing research and to be doing homework, not wasting the time at all, but not necessarily having the expectation that there's going to be some great waves to ride or some great sets coming in the immediate present and or immediate future. So it's nice to know that. If I know that the waves are going to be crappy and sloppy and choppy for the next few days, am I going to sit at the beach waiting for good waves? Probably not. Maybe I'll go build a surfboard or do something, you know what I mean? Watch surfing videos, read surfing books. I'll do something to, improve when I do finally paddle out. And trading should be no different. But if you paddle out every day just because there's waves, you're not a surfer. You're a fool. Not even the best surfers in the world do that. Except for this ridiculously dumb 20-year-old ego fools. But I'm not talking about that. I'm talking about the professionals. So flat really is a position, is the lesson, I think, for the day, and for the summer in many cases. You can see here on the 30-minute projection of the euro that while we're at the upper sigmas and everything right now, ultimately the cycle is still strong. So it is looking for it to try to follow through back up towards probably the gap highs, retest the gap highs at least, I think, before this cycle is complete. But it'll likely take, you got 20 time frames here forward. 20 time units forward on a 30-minute basis, so that's 10 hours. So a lot of you guys that are here today are regulars. What's your story? Talk to me for a couple of minutes. Are you guys finding your regular amount of trades, if you will, your normal amount of inventory for your business? What's the average person's inventory like lately? Higher or lower than your norm? By inventory, I obviously mean trades, because that's really what it represents as a business. Your trades are your inventory. So what's everybody running for inventory right now? Way down, Spin Doctor, yep. Me too. Now, is it by choice or is it dictated by your methodology? Mine's been a little of both, if I'm being honest. I was on vacation last week, so I was artificially pretty much flat through most of that. Not all of it, but most of it. But now when I come back, and re-engage fully back at mission control, I definitely see less on the radar screen right now. I mean, I've had many times where I'm holding, 5 to even more than that, 7 or 8 different pieces of inventory, i.e. trades, at any one time. Right now, I'm lucky to be holding 2. Hey guys. Hey Lewis. Yeah, so I'm not surprised. I'd be surprised actually if it would have been the other way. I mean, it's usually it's dictated by the wind, if you will. Our sales are dictated by the wind, and there's just not a lot of wind right now. That's why we call it the doldrums. So tomorrow, like Ed was saying as well, tomorrow afternoon, of course, or excuse me, I think it's tomorrow morning, right? We have Ben's, bumbling Ben's comments, as I like to call him. Which is always a fun dog and pony show. Yeah, BST, I have noticed that there has been a number of the smaller ones. My normal threshold is usually I don't bother with anything less than 50. I think I might have even mentioned it last week that if you traded in the 25 to 50 realm, you probably would do well still because it's probably all that's really going to be out there. And I guess, is that when you're watching those 15s in particular, or whatever, 15 to hourly, is that like the average movement you're finding now? Is it closer to 25 than, or a lot more that are, I should say, less than 50 than more than 50? Because that's what I started to see and just kind of figured, all right, well, break time. Harmonic Hearst, that's the same. With the Hearst exponent, it's good the way it is. I don't think I can improve on that math. If I did, I'd probably be in a different business. Like being a mathematician. Oh wow, look at that on the 15 there. You got a bearish butterfly. Let's see, I've got an upward looking projection, so I don't want to get too messed up in that 155.50. That's only 40 points from current. If you picked off the high, it was good though. That's not really my cup of tea anyway. Where's this euro pound? Just doing nothing. Well, like I said, last week on vacation, so I missed most of those. But, well, maybe they're coming back to life then. Because I know for a little while there we went into a pretty slow period. And so I'm hoping that we see it pick up. It always does pick up slowly as the summer progresses. But anyway. Complete. My long euros, I'm in a longer term position trade. My average, I think, is 123. Yeah, my average price is 123. But I'm trading this 4-hour and have been since last week. It's only looking for a move to 124. It's really no big deal. I wouldn't even be aware of weekly divergence. I don't watch that stuff. Oh, I'm long the euro for the simple reason of probability. I don't have an opinion on it otherwise. I could care less. Don't know, don't care what they're going to do over there. But I do know the odds are pretty good that we'll get a bounce. And if we get that bounce, the odds are pretty good it goes to 124. So I don't know. I don't care. I'm not I don't have an opinion on the matter. I just have a position. If CPO is in agreement with harmonic pattern, however, the Hearst was not, would this stop you from taking the trade? Probably not. If CPO and the harmonic pattern were in agreement and Hearst was not, I probably would still take the trade. At best, I would reduce position size. That's probably not going to stop me. It's going to be cause for pause and probably make me scale into it with a little more patience. But as far as it absolutely filtering it out, no. If I had a Hearst exponent that was good and a harmonic pattern, but a CPO projection that was completely in the opposite direction, that would filter it out. Or if I had a Hearst exponent that was good and a CPO projection that was good and a harmonic pattern that was in the opposite direction of that, that would filter it out. If it was one of the other two things in opposition, then yes. But not the Hearst itself. The Hearst is like it's like the cherry on top. You know what I'm saying? I'm still going to eat the sundae if it doesn't come with a cherry. But it's nicer with a cherry. Below 122.50. Below 121.50s. I have them scaled down there. Oh, man. I'm not trying to hedge, and I'm not really trying to buy low. If I'm buying low, it's circumstantial. I'm simply trying to follow along with my method and probability. And if my method is correct, then yes, I will be, at least on a relative basis, be buying low and selling high, obviously, or I won't make money. But it's not. No, I wouldn't say. I would say there's a lot of things wrong with that statement. I wouldn't say commercial traders, for the most part, do this, and I wouldn't say commercial traders, for the most part, win most of the time. The statistics of traders en masse, whether you're Goldman Sachs or Joe Blow with a $10,000 account or a $10 billion account, it doesn't make you. The probability of success is really still the same for all parties. It doesn't really. The only thing is that Goldman Sachs has more money. They have more to lose, maybe, but they don't have any more. There's no more fundamental probability that they're going to be more successful than Joe Blow. The odds are still the odds are still the odds. You know what I'm saying? And just because you're a big trader doesn't mean you win more. It just means you have deeper pockets. You can probably do more things and withstand more pain than Joe Blow, but that doesn't make you better, and it doesn't necessarily increase your odds. Well, sure they can, but the last thing they want to do is actually move it. Because if they're moving it, then their very actions are going to be, for the most part, self-defeating unless they can hide it and keep it a secret long enough, which is almost impossible nowadays. Sure, they're going to move the market with their orders. I know George Soros I know firsthand that or secondhand, I guess I should say, but I know basically directly that he's thrown 1,000 contracts at the S&P futures market at one time. That's going to move the market when George does that. Absolutely. But is he the beneficiary of that? No, because if he takes the same order and throws it the other way, the movement that just happened will probably go the other way and then some. So it'd be a wash at the end of the day. I've talked about this a million times. I don't even really want to get into it, but George will tell you himself, it's a complete joke to credit him with breaking the Bank of England. He did not break the Bank of England in the 90s. He simply put on a trade, and he was right. It just so happens that the Bank of England was standing on the other side of that trade. But he didn't break them. He didn't control them. He didn't manipulate them. He didn't do anything. He simply had an edge, a mathematical probabilistic edge, and he took a position. It happened to be a pretty darn big position. But he didn't do anything bad. He didn't break anything. He wasn't You know what I mean? It wasn't anything like that. He simply put on a trade like anybody else. The idea that he's moving the market at his will is completely misguided. I mean, if he could do that, believe me, he would, and he would be not be one of the richer men in the world. He'd be the richest man in the world. But it doesn't work that way. Richest man in the world is who? Carlos Slim, right? Not a market guy. Or did he fall back now? I don't know. Whatever. But I mean, it's not about that. I think people get very lost and confused. It sounds like a great Cloak and Dagger James Bond world or something, I guess maybe, but it's really anything like that. They're out there. Their size makes it harder for them to do business, not easier. And George will be the first person to tell you that too. Oh, would they move the market against themselves? Sure. I mean, now you're going back to like Ted Warren. Not Ted Warren. Excuse me. What's his name? Boy Plunger. Boy Plunger. What's his name? I can't think of it right now. Anyway, sure. Or they would move the market against their initial position. If they wanted to buy, they'd start out selling. Sure. But you got to understand, we're talking about the currency market, guys. We're not talking about little Tom, Dick, and Harry stock markets. You know? I mean, sure, individuals can manipulate silly little companies because they're not worth that much. They're worth a few, $1 million, a few $100 million. There's a few of them out there that are worth a few $1 billion. Whoop-de-doo. Okay, we're talking about currencies here, global currencies. We have $4 trillion plus of daily turnover. The euro itself represents what? $500 billion a day? So, I mean, let's be honest here. You really think that one person in a $500 billion a day pool, even if they have billions of dollars, is going to have much of an effect, even if they want to? I mean, just look at it logically from a baseline, you know what I mean? I'm not saying you won't have an effect. Obviously, if you have a pool of water and you put a single crystal of salt in the water, you fundamentally do change the water. It's now salt water, even if it's thinned out massively. But that doesn't mean, you know what I mean, that it's going to kill all the freshwater life that would rely on that water. You know what I mean? I don't know if that's a good analogy, but... So anyway, I don't want to waste any more time on it because it's really exactly that. Bottom line is, you're talking about the boogeyman. The only person that always won was Bernie Madoff. Until he lost. And that's the only one. No, I'm not kidding. I'm serious. That's the only one. The only way that you can always win is to be cheating. That is the only way. There is absolutely no one who's doing it fairly that's always winning. And that's not me being like crazy or whatever. That's math. It's not possible mathematically. Not my opinion. Doesn't matter if you're in the 1%, if you're in the 0.1%, if you're in the 0.0000001%. Doesn't matter if you are Carlos Slim or George Soros or Warren Buffett or Bill Gates or Uncle Joey or whoever. Doesn't matter. Nobody always wins. The amount of money you have has no bearing on that. Mathematical reality of Mother Nature has a bearing on that. And there's no human being that's going to beat Mother Nature. Not in this life or any other. Wow, how did we get on this topic? Anyway, you can see the euro pattern, like I said, that I've been looking at here, looking for the follow-through over the longer haul. It's just kind of slowly chopping its way around, trying to make it higher. But as I said earlier, I wouldn't look for any major immediate follow-through, especially you can see on this hourly here, it's drifting sideways. 30-minute, or excuse me, 15-minute, you've got a little bit of energy left in it, but probably, as I said earlier, only a retest of the gap opening highs from last night. And then from there, we'll have to reassess. The reason the big money players have the perception of always winning is they never quit. That might be what you're seeing. The reason I'm still here is because I've never quit. I've been trading for 23 or 4 years now. And the only reason I have anything is because I've never quit. The other 95% that call themselves traders are only that temporarily. They're not in it for 20 years. They're in it for 20 minutes. 20 days. Maybe 20 months if they're lucky. And then, I mean, in what world would you expect success in a 20-month tenure? You know? If you tried to be a professional taxi driver, if you tried to be a professional ditch digger, if you tried to be a professional janitor, if you tried to be a professional anything, even a low-paying level job, would you expect to be the highest in your class in 20 months? No way. It's not about what you're going to do in a year or two. It's about what you're going to do in 10 years or 20 years. You know? If you're going to find success in this business, it's not about the next trade or the trade you're in now or whatever. It's about your next 1,000 trades. If you don't know what your next 1,000 trades are going to be, then you shouldn't be trading. I mean, I know what my next 100 million trades are going to be. They're going to be the same as my last 100,000 because they're all based on the same thing. And that'll never change. Probability is not all of a sudden going to shift. Even if on December 21st, 2012, the poles shift and the magnetic field reverses and everything else gets thrown into chaos, which is unlikely. But even if that happens, probability in and of itself is still not going to shift. And therefore, everything that I'm doing in the market's not going to shift. Because that doesn't change. Math doesn't change. What if the 1% have more money than the other 99? It's not what if, they do. Can they manipulate the market? Sure, small markets. That's why penny stocks exist, so that we can manipulate them. But not big markets, like that's what I'm trying to say. How long did it take me to become consistently profitable? Too long. The first decade of my trading career was like most people, scattershot, all over the place, trying different things, trying to figure out something that would work. Luckily, I had the ability to make it through that long of a period of time. But the bottom line is it took far too long as far as I'm concerned. In hindsight, it should not have taken me as long because I should have learned faster. But I was stupid and I was arrogant and I still am, but it was really bad then. But once I got serious about it, it only took about 3 months. Now, does that mean I was making money consistently? No, but I was acting consistently, and therefore the ability to ultimately make money came into hand, became a reality. If it's always based on the same thing, the last 100,000 trades you made, will you get bored? Do you ever get bored? Are you kidding? Trading is the absolute most boring thing you can do. It's absolutely boring. It's supposed to be boring. Good trading is boring. That's the point. That's exactly what you're looking for. I want the most bored out of his mind trader in the world. That's who I want to hire. I don't want anybody who's excited or exciting. I want boredom because it should be methodical. It should be the same thing over and over. It should be like a freaking conveyor belt on a factory in Ford where you do the same thing over and over and over and almost mindlessly. Because at the end of the day, it's all based on simple mathematics. And does the market ever change? I don't know. What's the market based on? The human animal. Does the human animal fundamentally change? Are you fundamentally different than your great-great-great-great-grandfather? Is your fundamental response to external stimuli different from your great-great-great-great-grandfather? Like if I slap you in the face versus I slap your great-great-great-great-grandfather in the face, are you going to both react massively? So, I mean, that's the way I would look at that question. Of course the market doesn't change. Does it go through different cycles? Of course it does. But does it ultimately fundamentally change? Of course not. Not until we do. And I'm not waiting on that one. I'm not holding my breath for the human animal to fundamentally change. Call me a pessimist. I mean, we haven't fundamentally changed in at least 5,000 years. So the idea that it's going to happen next week or, you know what I mean, of course not. So no. But sure, does the market go through different cycles along the way? Of course. We're in a slower cycle right now. But that doesn't mean it's changing. It's not going from Batman to Superman. You're just getting a different view of Batman. One minute we were looking at his knee, the next minute we're at his elbow, whatever. Still Batman. You know what I mean? It's not fundamentally changing. And the idea that the market is going through fundamental change is misguided. Even with all the new high-frequency trading, what's the still common denominator that doesn't change? Whether the order is entered by a computer or a human, what's the underlying fundamental thing? It's still the same. It's still ultimately a human thing. I mean, the computers have not taken over yet. This is not the Terminator yet. We may get there, but we're not there yet. At the end of the day, it's still a human experience. It's still a human thing, driven by human emotion. The markets are not moving based on pure mathematical things, of course. If it was, then I would win 100% of the time. But I don't. I can only win 60 to 70% of the time. Because there is no perfection. There has to be infinite degrees of freedom in a nonlinear system. It doesn't have to be, but there is in this particular one. So it's right. At the end of the day, the underlying animal that's creating this thing, if computers cease to exist, the market's still there. If humans cease to exist, the market's not there anymore, is it? You might have the computers that can run it, but if nobody's executing orders anymore, hello? So that underlying thing doesn't change. Never will change. Well, sure, fear and greed are a primal thing. That's hard-coded into your DNA as a survival mechanism. Fear and greed is not something that you learn. That's coded into you, into all of us. It's coded into all life. I mean, think about it. Let's look at a dog, okay? If you beat the heck out of a dog, which, God forbid, no one should ever do, but if you kick a dog around, the next time that dog sees you, it's going to cower in the corner. Conversely, if you open up an entire 25-pound bag of dog food and dump it on the ground, that dog's going to eat as much food as he can possibly fit in his stomach until he makes himself sick. Fear and greed are hard-coded into us. He didn't learn to be fearful. He learned to be fearful of you, but the underlying fear, the idea of fear, the emotion of fear didn't have to be learned. That was already there. It's just now it has to be directed at you. And it's the same thing with greed. The desire to go nuts on the food, it's not that he's greedy, it's survival. It's what he should do, because who knows? Mother Nature knows that he doesn't know when his next meal's going to come, so why not gorge himself when he has the chance, even if he gets sick? So fear and greed are never going to change. They're hard-coded as a survival mechanism into all living beings, including plant life and everything else, viruses, you name it. If it's alive, it has fear and greed coded into it. And that's not going to change, and it hasn't evolved. The fear and greed that you feel is the same, like I said, that your great-great-great-great-great-great-granddaddy felt, and it's going to be the same that your great-great-great-great-great-grandchildren feel. That's why these patterns repeat over time, ultimately, because everything, A, is cyclical, and B, it ultimately, our responses to the world around us are non-random. As life, I don't just mean as humans, all life's responses to stimuli in the world outside of it, the world it lives in, are non-random. It doesn't mean they're absolutely predictable, but they're not random. And if they're not random, then there's a pattern. And if there's a pattern, then you can follow it. And if you can follow it, then you can assess probability. And if you can assess probability, you can have an edge. And if you can have an edge, you can make money. Anyway, this has been an interesting discussion today. Anything else you guys want to go over? I only got about 5 minutes left before I got to wrap it up here. I've said it a million times, if you don't know what your edge is, you don't have one. It's so incredibly important to have some kind of an edge, and I'm in no way, shape, or form trying to say my edges are the best one. They're just edges. There's infinite number of edges out there that you can find for yourselves. It's not important which edge you find, but it is important that you find an edge. And then what's even more important than finding an edge, because that's actually the easy part. The hard part is once you have the edge, is resisting the temptation to do other things. Steve Jobs was famously quoted. I love this quote from Steve Jobs, and I'm probably not going to get it exactly right because I'm doing it from memory, but basically he said that people misunderstand what focus is. People think that being focused on a goal, like becoming a successful trader, means spending more time focused on that goal and saying yes to the things that get you towards that goal. He says, in fact, that's incorrect. What focus means is saying no to all the other good things and brilliant ideas and other great edges that do present themselves along the way, because they do. So it's not about being open to all this new stuff. It's about being open enough to find something and then closing your world off and just sticking to it. And that's the part that the 95% doesn't have the ability, for whatever reason, I don't know, don't care why, but the vast majority of the people who come into this business don't have the wherewithal to stick to it for some reason. And I would argue for most of them it's a mental thing. But whatever. So, that's my take on it. How about moving stops to break even? I'm a little out of context on that question now. I'm not sure. Oh, stops to break even as a topic? Sure. What do we have? We only have a couple of minutes. I can do my stops to break even spiel in 2 minutes. Simple. I have 2 rules when I move stops to break even. It's super simple, because I love simple. Simplicity is the highest form of sophistication. Also a Steve Jobs quote. Well, he kind of quoted Einstein from that too, but whatever. Anyway, 2 rules. You use whichever one comes first. If your original stop is exceeded by your open profit, then stops must be moved to break even. So if you had originally had a 50-point stop on a trade and now you have a 50-point open profit, you must move your stop to break even. I don't care what the underlying market's doing. I don't care what your signals, what your charts, what your uncle, what your dog, what I don't care what anybody else says. I don't care. It doesn't matter. You do it regardless. You do it like a robot. Could care less what's going on in the real world or whatever. Makes no difference. You move the stop to break even and you remove the risk and you are damn happy that you did. Or the other rule is if you have achieved a move of 50% or more towards your target, whichever comes first. So in other words, if I was in a 50-point risk and I only had a 75-point target, which would be a 1.5 to 1 risk-reward ratio, which would be acceptable, then in that particular case, when would I be moving my stop? At what number would I be moving my stop? Is it 32 or 37.50 now? Now my brain just crunched it the wrong way. I thought it was 37.50. Yeah, okay. Anyway, so exactly. Because that's the 50% level, so that's the one that happens first in that particular example. So it's just that simple. Jawohl? So anyway, that's the way I do it. Real simple. Do I get stopped out at break even a lot? Sure. Do I care? Not a damn bit. Because I can take 10 trillion break even trades. I can take 150 billion trillion break even trades. They don't hurt. I'll have infinity squared break even trades. Thank you. I mean, I'm not getting anywhere, but I'm also not going the wrong way, which is more than most people can say. So, nothing wrong with a break even trade. I'll make out with a break even trade anywhere. Get all sloppy and tongue. Heavy petting. Anyway, so I do need to wrap it up. So be safe this week. Like I said, look for lots of choppy cross currents. Markets are giving us, I think, anything but clear signals. So, caution is the better part of valor that people like to say, and I think they're right. Flat is a position, and just because the market's moving doesn't mean you should be trading any more than you should be paddling out into waves just because there are some. So, that said, be cautious. Thank you, FX Street, as always, for everything. And I will see you all back here next week.